So one of the things that I talk about all the time is the fact that I believe whole life insurance should be a foundational cornerstone asset in every single person's life. The reason I say this is because no matter where you are, whole life insurance is the only financial product I know alive that will fulfill multiple duties in your life. It's a way to get your dollars to perform more than one function. It's just leverage. And in this video, what I'm gonna do is I just got off a conversation with somebody and it got me thinking about the fact that whole life insurance is with you. It will grow with you through every phase of life. A lot of times I feel like people try to think about, all right, how do I get into it? How do I start it? And then how long do I have to pay? When can I stop? But if you really understand the leverage that whole life can provide you in your life, you will understand that you want to get started with it as early as possible. And when you do, it's going to help you in all these different ways. So what I'm going to do in this video is I'm going to go from very beginning of adulthood at 18 years old, all the way through the different phases of life in retirement, and then ultimately into our graduation from this earth, into legacy planning, and talking about the different ways that whole life insurance can help you along the way, and how this one simple product, you can pivot in how you utilize it throughout your life, but it's always there to be there when you need it. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into this. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we're going to be talking about whole life insurance and ultimately how can you leverage whole life insurance in different ways through the different phases of life. Now, full transparency, this just happened. I just kind of had this brainstorm as I was having a conversation with somebody about the power of whole life insurance, somebody who's a little bit younger, talking about the different ways that you can utilize whole life insurance. And I was like, man, this is a great idea for a video because I think it's important that people understand it. And so what I did is I took a couple minutes and I went through this and I was like, wow. And I'm gonna share my screen here. I was like, wow. I went through this and I was like, let's think about the concepts of what we're doing here and the different phases of life. And I didn't take a ton of time to really map it out and spend a lot of time thinking about titles and all that stuff. So full transparency, I maybe spent 3 minutes thinking about this and I just kind of wrote it up. So give me a little grace as far as the titles and all that stuff go. But at the end of the day, what it comes down to is we have our foundational years. This is when we're first getting started in life. A lot of times starting at 18 years old, when we get out of, leave our parents' house, maybe we go to college, maybe we're just starting our careers, whatever. But between 18 and 25, that's kind of when we build our foundations. It's when we learn to figure out our beliefs around certain things about money. We start testing things for ourselves as adults, as we fly the nest of our parents, and we try to figure out how do we want to show up in this world as adults, as productive members of society, and go from there. Now, typically, that's between the age of 18 and 25. Now, once you figure it out, at about age 26, I find you decide, all right, I'm going to start trying to launch my life. I'm going to start being more intentional about what I'm doing because I've now got a foundational, at least framework and belief of understanding about what I want to attempt to accomplish. And I can kind of make a plan, right? If you will. And sometimes this happens earlier, sometimes it happens later. Once again, this is just a general framework, right? To go by. Then we have the momentum phase, right? So when you go through 26 to 35 and you've got that launch phase where you're trying to build up, it takes a lot longer than most people realize. Sometimes, once again, it happens faster, but between the age of 36 and 45, that's when you should start getting momentum. That's when you should start earning some income. That's when you should take the efforts that you've had during the launch phase and start getting momentum on it, and you should start getting some good results. You should start making more money. You should start being able to save more money if you haven't already. This is when things should start to have come together for you a little bit. Now, at 46, this is when you hit the maximization phase. These are going to be your highest income earning potential years, period. A lot of times, during the momentum phase, one of the challenges to the momentum is you have kids that come into the equation, you get married, you have all these things that are going on. Typically, you, I guess, would get married in the launch phase, but kids will happen in these two phases. You have a family that you have to deal with here, right? And so it's not just about business. A lot of times it can be hard because you're making more money in this phase, but you also have a lot more expenses going out as well, right, during these two phases. And that can be challenging. So the maximization phase comes into play where it's like, all right, I now have the kids are going to be starting to leave the house, college, whatever, all these things. My free and clear cash flow is going to start to go up, and my attention and focus can go into the creation of what I'm looking to build, and I can start focusing more intentionally on accomplishing my long-term financial goals, all the things that I've been allocating my resources and finances to. I can now kind of reallocate those towards my financial future and my own financial goals. Like, once again, not to say that you're not doing that at all the entire time before, but anybody that's raised kids, anybody that has a family, is married, you understand there are pulls on what you have going on, right? And so it's important to understand. Now you hit the phase of preparation. And what I mean for that is you're preparing for retirement. Between 56 and 65, you got to start thinking about, all right, what does this look like? I just went through this maximization phase the previous decade, and the goal is to save up as much money as possible. And this is where I want the risk to have come into play. I've accomplished some goals. I've got some money saved away. And now what it's about is really preparing that money to make sure that it's safe, to make sure that you're not going to lose it, to make sure that you're prepared and that you build a bunker and that you actually have a plan to get you into the financial freedom phase. Because this is where the preparation phase is. You have to go from thinking about, how do I put this? You got to go from thinking about the accumulation, I'm going to write ACC for accumulation, to distribution, right? So there's going to be a transition between all the years before, from your foundational years, from when you turned 18 all the way to when you turn 65 for typical retirement planning. This is accumulation, so that your entire career you've been used to living with this accumulation mindset. Well, the last decade here, this preparation phase, it's preparing your money, but it's also preparing you to understand that you're no longer going to be in this accumulation phase. You're now in a distribution phase, and how you need your money to behave for you, how you need to behave around your money is going to completely shift. And so that is really important to understand. So once again, these are just, the 1, 2, 3, 4, 5, 6 phases of life, effectively, right? That we come for. And I guess I would put 7, and I would say the legacy phase, right? Which is when we graduate from this earth, right? So 65 to graduation, we need to think about how are we going to pass this on, pass our money, pass our wealth, pass our estate on to the next generation in the most financially efficient way possible, and in a way that's done to educate our kids, to educate the next generation, to make sure that we're not just hammering them with a trust and with all this money, or outside of a trust where they have all this control, and you give them this asset that they don't understand, that they don't know how to deal with, and maybe they blow it, and you're concerned about that. So that, to me, the legacy is not just the money that you pass on, it's the skills, it's the knowledge, it's the ability to leverage that money and putting your next generation in a position where they can actually win, right? And so I say all that to really share why I think it's so important to leverage whole life insurance properly, to leverage a properly designed whole life insurance policy, because at every stage of the game that I showed in whatever phase, starting from the foundation phase when you're just trying to find yourself and build your beliefs and values and all these different things, all the way through when we graduate from this earth and we pass away, and we got to worry about transitioning what we've built in our lifetime to the next generation. Whole life insurance is there for you. And what I'm going to do is I want to go through this illustration. I have an illustration. I had it put together. And the reason I did it is because and it's for an 18-year-old all the way through, obviously, when they die, potentially. And what I want to do is I want to go through this and evaluate what this policy can do for you at every stage of life along the way. And ultimately, what I would encourage you to do is, if you realize this, and if you build these principles, and if you build the financial foundation, and I talk about here that in the Life 180 pyramid, I talk about this a lot, where we need safe money here, right? But I talk about this a lot, where whole life insurance should be the foundational cornerstone asset in your financial pyramid. And the reason I say that is because of all the benefits and attributes that a whole life insurance policy, when it's designed properly, can do for you. And in this video, hopefully you're going to see, as I go through this illustration, it's going to make a lot of sense. And so what I want to do now is I want to go right to the illustration, and we are going to talk about it a little bit. And so you can see here, We have a 18-year-old, so at the end of year one, they're gonna be 19, right? So like it's showing the end of year, all these things are showing. So this is saying somebody, and mind you, I said 18. If you're going to college, obviously this would delay to probably 23 or something of that nature. But I'm just starting at 18. Once again, it's just to talk about the concept. If you want to say, hey, I'm not going to start till 23, delay things out by 3, 4, 5 years, it's not a big deal. The whole point here is the concept of everything, right? And understanding the different phases. And so as we go through this, you can see what are the first needs out of the gate. Now, a lot of people are saying, well, I don't need whole life insurance, right? I don't need whole life insurance because I don't have any kids. I don't have any family yet. I don't really have a need for the death benefit. So why would I do that? Why would I put my money into whole life insurance? Well, the answer is because I believe most people at some point in time are going to want to have a family. They're going to want to get married. And at the end of the day, life insurance is never going to be cheaper than it is right now when you're 19 years old. You're probably never going to be healthier than you are right now at 19 years old or 18 years old. And so from that perspective, it's just leverage, right? And when you see how it will grow with you, by the time you do want to start a family, by the time you have kids, you've got a lot of the things that you need kind of taken care of, which is fantastic. And so that is an important thing to understand, that you're just kind of like checking future needs, checking the boxes of future needs, potential needs at least, and there's really no downside to doing that. And I think I'm going to show you what I mean by that. Now, the other need out of the gate is, I believe, one of the biggest challenges in personal finances for people is the fact that we are massively undersaved and we invest too much too soon. We take on too much risk too soon. And what I mean by that is like we need to not worry about trying to chase massive returns first. This is the point of building a financial pyramid, building your financial foundation on safety. And that safety has to start with an emergency fund and should have an opportunity fund component built into it, what I call a cash flow hacking fund. And so from that perspective, what are we looking at? We're looking at like, okay, at 19 years old, year one of the premium, at the end of year one, you got $10,000 that you put into a premium. Now, are there costs behind this? Yes, there are costs of the insurance. You know, you can see here you put in $10,000 of premium, but there's $7,000-ish available. Now you pick up a death benefit. That's fantastic. And you can change who the beneficiary is of this death benefit. Obviously, as you grow older and have relationships and get married and have kids and all this stuff, that you can adjust who your beneficiaries are. Maybe initially it starts with your parents or a family member or a nonprofit organization that you care about, and you can kind of adjust from there based on where your values, where your beliefs, and where your relationships are, right? That's important. But you can see year two, it gets better. It ultimately, as this policy grows, by year 10, you've put in $100,000. You can see the cumulative premium here of $100,000, and you see the net cash value of $106,000. So here's the cool part. As you've done this, because of the paid up additions, because of the way that we're doing this, you can see that you've started with a $249,000 death benefit. You've put in $100,000. The death benefit has grown to $490,000, which is pretty phenomenal, right? Because you would think I put $100,000 in, maybe the death benefit would grow to $350,000, but it's actually grown to $490,000. So that's because of the efficiency of the age and the paid up additions and how it works. And so a lot of people always ask, like, well, why does the life insurance company keep the cash value when you die? Well, it's because they're just lumping the cash value into the death benefit here, because when something happens, because eventually we're going to die, right? When that happens, you get to this death benefit goes on a favorable tax-free basis, whereas if they were to segment it, this would have to be a taxable account, kind of like a savings account would be. So that's why they do that, and it's important to understand that. You can see at year 10 here, I'm putting $10,000 into the premium. It's growing by $13,387. And all this is very, very consistent, very, very predictable. And it's very powerful when you start to understand like the different leverage that this policy can provide you in this policy, right? Like, so it just from a safe, liquid, accessible capital perspective, it's extremely powerful. Now, when we go back here and we talk about the different phases of life, right? We got the foundational phase. All right, we're building up. What are we trying to do in the foundation? We're trying to build an emergency fund. So between 18 and 26, We're trying to build an emergency fund. Well, you could see here, if we do this and we just take $10,000 a year of our savings, which will build the habit of not living above our means, saving $800 a month, maybe out of the gate, you're living with your parents still, you get a job out of the gate. I can't tell you how many people I talk to that are in that spot that can save $800 a month if they just needed to. By the time you get 26 years old, you got $80,000 saved. You got a $432,000 death benefit. Now, if at 30 years old you get married, you've already started off with life insurance. You've already started off with a good foundation. You're a good financial steward. You've got this money set aside, and it's great. Now we start talking about launching your financial life, like really implementing a plan. Okay, between the age of 26 and 35, that's your launch phase. Imagine if you got to 26, 27 years old and you had $80,000 to $90,000. And you could have that as an emergency fund, or maybe you wanted to utilize it as a cash flow hacking fund or an opportunity fund. You could actually start utilizing this money for real estate investing. Access to capital is king when you're talking about looking for opportunities to invest in. And so what are we talking about here? We're saying, all right, we got this money that can be leveraged, at least portions of it, that can be utilized for down payments on rental properties, on cash flow assets. Maybe you want to buy a Turo fleet to rent cars. Maybe you want to buy an Airbnb. Maybe you want to buy long-term single-family buy and hold kind of cash flowing properties. I don't know, but the principle doesn't change. Maybe you want to utilize this as a day trading fund. A lot of people, I've talked to a lot of people that have utilized these things in a lot of different ways, and at the end of the day, it really is something that you can customize. But the concept here is during the launch phase, you're saving during the foundation phase, but you're saving with the intent of investing. And when you invest, you want to invest in cash flowing assets. So now at 26 years old, you have a fund that you can look for cash flow investing opportunities. And because you've taken this money, guess what? You're going to grow a lot during this first phase. You're going to build financial principles and build financial habits that are going to really help you during that launch phase. So between 26 and 36, honestly, for most people, you're going to keep saving, you're going to do this. And when we talk about, going through all the way through phase 6 or 7 down here, where we're talking about hitting financial freedom at retirement, for most people that follow this plan and do this and are willing to go slow to go fast, and during the foundation phase are willing to build this up, this next 10 years between 26 and 35, this is the time, like right here, you honestly could reach financial freedom in that 10-year period just by doing that, and you could expand upon it. For the sake of argument, or for the sake of simplicity for this video, I'm just focusing on kind of traditional mindset, traditional ways of looking at how people typically handle their money. I would encourage everybody to realize the fact that there are better ways to look at this, and you should be able to reach financial freedom before the traditional retirement age of 65. So now at 36 though, what happens is we hit momentum, right? We've taken what we've had, we've got all this capital that we have access to, we have momentum, we can leverage this for more cash flowing assets. We borrowed against this money for cash flowing assets. This money is going to be available. We have other assets growing on the side, right? We have other investments. Once again, this is not the investment. This is the savings vehicle. This is the foundational asset that we're leveraging very similarly to a way we would leverage a bank to go get loans to get access to assets. The difference is we're in complete control of this. This is where the becoming your own banker concept comes into play, right? Like, you have to understand that. You have ultimate control, and the number one attribute that I'm looking for in any asset, in any financial vehicle, is control, and this is the number one reason. So during the momentum phase, we're talking about between the age of 36 and 45. We're talking about like really trying to build that momentum and trying to double down on what we're doing. And if we bought a couple rental properties the first 10 years, we want to like quadruple that, or even 10x that over the next 10 years. That is what I'm talking about, maximization of everything. And then when we hit that point in time at 45 years old, you could see we've got $451,000 here. We've got $1 million of death benefit, but we've also probably got $3, $4, $5, $6 million of real estate because of the way that we've leveraged this to be able to accomplish it. And this is where, we're talking about the real maximization of everything. Sorry, I think I used the word maximization when I meant momentum in the previous one. We're building that momentum, we're building up the policies, and now we're taking everything we've built and we're maximizing it all over the next decade. These are going to be the highest income earning years of our life. You get to, once again, because you are going to grow into becoming who you need to be to get to where you want to be through this entire process. That's my favorite part of this whole deal. And during this maximization phase, you are going to accomplish things that most people only dream they could accomplish, right? And so when we do that, we go down here all the way to age 55, and you can see by this point in time, we have a safe, liquid, accessible capital fund that we can utilize for real estate, for business, in whatever way that we want to prepare for retirement. And it's there to protect us. It's there thinking about our legacy. It's there ultimately making every investment that we make, every asset that we have, every financial decision that we make, making those have the potential to be more efficient based on the principles that you're implementing. Now, when we look at this, now we go into the phase that we're in the preparation phase, because from 56 to 65 years old, you are dealing with the fact that you are now entering that transitional phase in your life. I would argue, once again, this probably happened sooner, but once again, talking about traditional timelines of people in retirement and the way they handle their money, we're talking about that period of time. Traditionally speaking, you got to start thinking about, I've been in the accumulation years. I'm going to have to start thinking about what's it going to look like when I hit the distribution phase of my money, the assets that I built up. Now, if you've done real estate and you have cash flow real estate and stuff like that, we do a lot of that. We do a lot of coaching around that. That will have an impact. But the goal is to make sure that you take this phase to position your assets in a way that by the time you hit retirement, 65, let's say for the argument's sake, that you have your whatever cash flow that you need to sustain your quality of life, your standard of living, whatever you need on a guaranteed basis, that you utilize that 10-year window of preparation to lock that in, to make sure that it's locked in stone, that you will never have to take a step backwards as far as your standard of living. That is what retirement is all about. I don't care how much money you have. I care about what your cash flow looks like. I care about your ability to sustain your lifestyle, because that's ultimately all that matters. I don't care how many millions of dollars you have. I care what those millions of dollars are ultimately going to be able to allow you to have for quality of life. That's what it comes down to. Now, we hit retirement. What are the different needs that we have in retirement? Well, once again, this policy is not an investment. I know we're looking at it going like, there's $1.2 million here. That looks like a pretty good investment. Well, the internal rate of return on this, you're talking about like 4 to 4.5%. It's not phenomenal, right? Like there are plenty of other investments that are going to do better. But as far as safe, liquid, guaranteed, accessible capital, there's not an asset in the world that's going to compete with this. And so the fact that you have $1.2 million in a bucket at retirement, as I've showed you, it's fulfilled all these duties as you've grown through life. Now you hit this retirement phase and you're not looking to accumulate more real estate. You're not looking to buy more business. You're not looking to do all these things that you've leveraged this policy for during your accumulation years. Now you're looking at, how do I pivot and utilize this policy for my distribution phase of life? You're going to have probably other assets, other investments. Maybe you have cash flow coming from real estate. Maybe you've liquidated some real estate because you wanted the cash and you want to put that into other assets. At the end of the day, one of the worst things that you could do is liquidate negatively performing assets. Well, the one thing that's guaranteed is during retirement, as you are in retirement, between 65 and let's say 95, if you're in retirement for 30 years, it's pretty much certain that you're going to have really, really bad years. We're going to go through multiple boom bust cycles like that we're kind of experiencing right now, right? And so during those phases, all it takes is 3, 4, 5 really bad years in retirement if you don't have the right safeguards put into place to completely blow up your investment portfolio, even if you feel completely secure right now. So one of the ways that we leverage one of these whole life policies in retirement is by saying, hey, if I need $100,000 a year of income or $200,000 a year of income, I'm gonna not lean on the whole life policy every year to pull out of that income. But what I am gonna do is I'm gonna utilize it as a volatility buffer, meaning I don't wanna ever liquidate for income negatively performing assets. And so by having your money in a whole life policy or having this pool of money built up, let's say you get to age 70 right here and you got $1.5 million and $2 million of death benefit. You hit this age and that's the first year that there's a really bad year. Let's say the market goes down 20% and you have like $4 million sitting in investment accounts. Well, that's $800,000 that you just lost. If you had to pull $200,000 out of that account that just compounds the issue for the loss, because now not only do you have to earn to get back to zero, you got to earn the opportunity cost of the loss of spending that money, liquidating a negatively performing asset. So by having this whole life policy as what we call a volatility buffer, you are able to take money out of a guaranteed account that didn't lose money during bad years. You give your account a chance to bounce back and recover, which will dramatically enhance all of your other assets and all of your other investments. That's what we're talking about when we talk about financial efficiency in retirement. That is how this can work. Now, one of the things that I also want to show during retirement that we don't think about is the fact that we need to have consideration about our health, right? We need to realize that things happen to us. And by the way, this is not just when we're in retirement. This is our entire life. That we need to be taking this into consideration. It especially affects us when we have kids and obligations and responsibilities to other human lives, right? And so let's say by the time you're 30, you've done this and you have all this stuff. If you become chronically ill or terminally diagnosed, you have access to a portion of the death benefit while you're alive. You can see at 35 here, you could access up to $343,000 for alternative medical treatment or whatever you want if you're diagnosed with a chronic illness. A terminal illness, same deal. You can get $418,000 up front. And if you do this, you could see if I took $418,000, the remaining death benefit would be $149,000 above and beyond that. So it's a really, really powerful thing. But the reality behind this is like, listen, we are much more likely to run into issues when we're alive. I use a story about my father-in-law a lot. At 72 years old, he was diagnosed with pancreatic cancer. The doctors gave him 3 months to live. They found a 7.5 centimeter tumor that was on his pancreas that had spread to his liver. For anybody who understands that stuff, they understand, like, we went in, we talked to the oncologist. The oncologist basically said, we may be able to get him to a year, but his quality of life is going to be garbage. And my suggestion to you is enjoy the time that you have left with your family. And we could do chemo, we could do radiation, but it's really not going to do much. And so we said, no, heck with that. We're not doing that. We're going to go, and we're gonna go a different direction with this. We're gonna find alternative treatments because we know we can beat this. I'm personally not a big believer in Western world medical stuff. I'm a huge believer that our bodies have an amazing ability and power to be able to heal themselves if we feed them what they need to be able to heal themselves. Now, there are other natural ways that we can deal with this, but the body is like wildly powerful, right? And so we said, because of the fact that he did that, I'll tell you this now, almost 3 years later, he's alive and he's playing golf 4 days a week. And he's got it under control, and it's all through natural treatments. And he was only able to do that because he had a couple $100,000 in treatments that were required to pay for this stuff that most people couldn't afford. But because of the fact, look at this, imagine, and anybody could do this with this policy. And this is just another way it helps you in different phases of life. You could access $483,000 at 73 years old here just to maintain, terminal illness, lump sum, $1.9 million. If you accessed the 1.9, it's crazy. If you got chronic illness, you lose 2 of 6 daily living activities, you could access $1.9 million and still have $300,000 in death benefit. By the way, this is a tax-free benefit here that you can access to be able to help you with whatever medical needs that you have. And so I'm a big believer that, for long-term care, for disability, for health concerns, for terminal diagnoses, to be able to control your medical directive in a way that most people only dream they'd be able to do, this policy will help you. And so from the beginning of life, when you need an emergency fund, just kind of recap this, from that stage where you start off at 18 and you're young and you're vibrant and you've got the world at your fingertips and you're just trying to start off the right way, build your emergency fund, keep building that, build an opportunity fund, hit that launch phase of life, leverage the policy, make those investments better, get into positions, because opportunity tracks you down when you have these kinds of policies set up. When you have this kind of capital available at your fingertips, opportunity will track you down. It's on you to make sure that you do the due diligence to become who you need to be, to make sure you take advantage of those opportunities in the best way possible. But the fact that you have access to this capital is going to open the world up to you as far as potential possibilities, right? And then it's going to help you through the momentum years, through the maximization years. As you start to prepare, you've got this bucket of money that can help you make all your other assets better to meet your needs from a financial freedom retirement perspective. And then when you hit retirement, you have a volatility buffer, which is going to make an enhancement for all your other investments. And you have this accelerated benefits to be able to have and utilize this to make put you in the driver's seat and give you more control of your medical directive. And I don't know about you, but there's not another vehicle, alive, financial tool around that's going to be able to help you from every phase of life the way that whole life insurance will do in this capacity. And so hopefully this video gave you clarity around what that could look like for you, gave you clarity around the flexibility, the versatility, the leverage, the strength, the power that this kind of financial planning and utilizing a properly designed whole life insurance as a cornerstone foundational asset in your life, what it can do for you to accomplish your financial goals and objectives. One of the biggest things I say to people all the time is people are struggling with their money because their money is not in alignment with their values and beliefs, right? And so one of the things that I know to be true is after going through all the different phases in life, it's on you to be intentional about what you want to accomplish in each one of those phases. And I challenge you to think about, do you have what you need? Is your money in alignment with your values and beliefs at each stage? And I believe that a properly designed whole life insurance policy will help that come together for you. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. And also, if you have any questions, go down in the link in the description below. You can set up a clarity call with one of my coaches on the team. And as always, leave a comment in the comment section below if you have any questions, if you have any comments or whatever. I try to do my best to engage with every single comment that happens on this channel. And that's it. Have a blessed, inspirational day. We'll talk soon.